What happens when you weight the standard RSI calculation by time? Do you think it positively or negatively affects the results of the two-period RSI strategy that we tested in the first episode of this series? As you may recall, in the first episode we tested Larry Connor's two-period RSI strategy on 100 individual large-cap stocks and on the SPY ETF. The results showed a definitive edge, a 66% and 73% win rate on individual stocks and SPY, respectively, and both tests were profitable. However, in an effort to push our learning forward, we're going to modify the standard RSI calculation to see if a time-weighted version gives us a better signal. We'll test the same rules, the same position sizing, and the same starting capital. The only thing that's going to change is how RSI is calculated. And this time, we're not going to test it on just 100 stocks. Instead, we're going to test it on over 600 large-cap stocks across two completely different 5-year periods. This will generate over 60,000 individual trades, providing us with more robust results. I think you're going to find the results of this study pretty interesting, but maybe not for the reasons that you might expect. Now, before we go any further, please note that nothing in this video is financial advice. We are not financial advisors, and we are definitely not your financial advisor. Everything here is for educational and entertainment purposes only. Always do your own research before making any trading decisions. Also, just a quick reminder that we'll be launching our cash prize tournaments soon. These tournaments are free to enter and happen when we go live on YouTube, so be sure to subscribe to the channel and hit the bell icon to be alerted when we go live next. Now, if this is your first time here, this channel is all about testing trading strategies with real data to find out what actually works. We use a variety of platforms to run our tests, including our own Trading Blitz simulator, which is free, TradingView's PineScript, and a walk-forward optimization engine that we developed using Claude AI. Okay, let's do a quick recap so everyone's caught up. In episode 1, we tested Larry Connor's two-period RSI strategy from his book, Short-Term Trading Strategies That Work. The rules are straightforward. Rule number 1, the stock must be above its 200-day simple moving average, which confirms that the stock is in a long-term uptrend. Rule number 2, the two-period RSI must drop below 10, and this tells us that the stock may have experienced a short-term, sharp pullback. Now, when both of these conditions are true, you buy at the close. And then rule number 3, this is the exit. You sell when the stock closes above its 5-day simple moving average, or SMA. It's important to note that this strategy does not use a stop loss for downside protection. In Connor's original design, risk management was handled through position sizing. He tested using stop loss orders and found that they actually hurt performance. In our initial tests, we executed 100 trades on individual large cap stocks using the Trading Blitz simulator. Our starting capital was $100,000, and we used 10% position sizes per trade. The results came in with a 66% win rate and a profit factor of 1.27, and a total gain of $43.97. The average winner earned $313 and resolved in about 6 days, whereas the average loser cost us $478 and dragged on for about 16 days. So we're winning more often, but when we lose, the losses are bigger and lasted longer. That's pretty much the classic profile of a mean reverting strategy without stop losses. Then we ran the same strategy on SPY, and this time we used TradingView's backtest engine. SPY came in with a 73% win rate and a much stronger profit factor at 2.42. So this was more consistent, but it generated smaller individual trade profits and losses, which is what you'd expect from an index that's structurally mean reverting. Now, the question I posed at the end of that video was this: can we improve on the indicator itself? Now, before I show you the results, I want to talk about the tool that we use to run these tests, because it's not the same TradingView setup from episode 1. After episode 1, I started running preliminary tests on a handful of stocks using TradingView and PineScript. Now, the initial tests using this modified RSI looked very promising, so I wanted to scale the test up to hundreds of stocks and then compare the strategies head-to-head on the exact same data. But TradingView has limitations on what you can do at scale. In addition, the initial tests only looked at single-period backtests, and this has its own set of problems. Now, The comparison of individual large cap stocks against a basket of stocks, even though it was a single period test, was important for highlighting the mean reverting nature of using an index and how the instrument that you select can affect the strategy's performance. The problem with single period backtests is that they lack the robustness that comes from developing a strategy on one set of data, which we call an in-sample data set, and then testing it on another set of data called the out-of-sample data set. Now, luckily, I stumbled upon a video by a channel called AI Pathways, in which the presenter used Claude Code to build a proper backtest engine, which is called a walk-forward optimization engine. Now, in case you're interested in learning more about this type of engine or building your own, I've provided a link to the video in the description below. Now, there's some videos online that can show you how to do some pretty cool things with AI, but I want to give you a word of caution before you jump into these. Most of these videos are going to show you someone entering a single prompt and Claude magically spits out a perfect working application on the first try. Now, that's not reality. And it certainly isn't what happened here. It took me around 30 to 40 meaningful iterations over several days to get this engine working properly. Now, I did modify the original design in order to allow me to test two different strategies head-to-head. So for example, the standard RSI versus the modified RSI, and then to be able to enter parameters for both strategies so the engine could optimize for each one. However, even if I didn't take those extra steps, it would have required at least 15, if not 20 iterations just to get the calculations working properly for the original design as laid out by AI Pathways in their video. For example, there were discrepancies in the trade count, where the engine was dropping the last trading day of each period because of how the data library handles end dates. We had a memory problem where testing 600 stocks simultaneously crashed the entire system, so we had to build a two-pass architecture that saves intermediate results to the disk instead of holding everything in RAM at once. And then we had a portfolio calculation bug where the equal weight average was truncating to a 13-day series because one stock had a shorter history than the others. Now, every one of these bugs had to be found, understood, and then fixed individually. That's why I say it's not going to be a one-shot deal where you enter in someone's prompt and you magically get an app that works. You're going to have to test that app and verify that it's working properly. Now, the data we'll present in this video comes from this walk-forward optimization engine, not TradingView. We'll use the same strategy rules, the same position sizing, and a consistent methodology across every test. So, what exactly did we change about the RSI calculation? The standard RSI, the one that Connors used, the one that most traders use, treats every candle in the look-back period equally. It doesn't matter whether a big move happened yesterday or 12 days ago. Both get the same weight in the calculation. Now, exponentially weighted RSI, or what we'll refer to as weighted RSI for short, changes that. It applies a mathematical decay function so that the most recent price changes carry more weight and the older ones gradually carry less. Now, I think you'll find the idea behind this to be intuitive. If you're trying to figure out whether a stock is genuinely oversold right now, what happened yesterday should probably be more relevant than what happened nearly 2 weeks ago. Now, here's an analogy that may help. Imagine you're trying to decide if a restaurant is any good. Would you give equal weight to a review from, say, 3 years ago compared to a review from last week? You'd probably agree that a recent review should carry more weight for a variety of reasons. For example, the chef could have changed over this 3-year period, or the menu could have changed. The current state of things is more relevant than the distant past, and this is what weighted RSI attempts to capture. Now, the key parameter that controls how quickly the weights decay is called alpha, and we used an alpha value of 0.5, which gives a moderate decay. Recent bars get meaningfully more emphasis, but older bars still contribute to the calculation. They're not ignored entirely. Now, we tested the alpha values in later studies, and interestingly, 0.5 actually turned out to be a solid choice. Now, you might say that, well, hey, this is only a 2-period RSI calculation. How much could weighting by time actually impact the results? And that's what we'll get into next. Now, everything else about the strategy stayed exactly the same. The stock price must be above the 200-period SMA. The 2-period weighted RSI must drop below 10. When this happens, you buy at the close, and then you exit when the close crosses above the 5-day SMA. There are no stop losses. It's the same rules, the same position sizing at 10%, and a $100,000 starting account balance. The only variable we change is the RSI calculation itself. So let me walk you through the exact test setup so there's no ambiguity about what we're comparing here. Our universe was over 600 large cap stocks. 613 had sufficient data for the 2016 to 2020 period, as well as the 2021 to 2025 periods. Each stock gets its own independent $100,000 starting account balance and uses the 10% position size per trade. Now, just a quick note on costs. When running these types of tests, you should definitely include costs. However, we did not for one simple reason. Every broker charges differently, and the slippage depends upon factors like liquidity, order type, and time of day. And since everyone's using a different broker, everyone's using a different method for entering, what I wanted to do was to present the gross edge, the raw signal quality before your individual trading costs are applied. So rather than picking a number that might be wrong for your situation, this is how I wanted to present it at first. Now in practice, your results will be slightly worse, and later in this series, we will test this with costs separately. As previously mentioned, we tested across 2 separate 5-year periods. There was 2016 through 2020, and then 2021 through 2025. These represent 2 very different market environments, and I'll explain why testing both matters as we go through the results. All right, let's look at the numbers. Starting with the 2016 through 2020 period. The standard RSI test came in with an average total return of only 0.71% per stock. It had a win rate of 66.7% and a profit factor of 1.54. The strategy generated about 17,500 trades across 613 stocks, and 397 of them, roughly 65% of the stocks, finished the period in the green. These results are similar to our initial large cap test in the last video. The average maximum drawdown per stock was 2.23%. So now let's look at the modified version, the weighted RSI. The average total return came in at 1.79% per stock. That's 2.5 times what the standard RSI produced on the same stocks during the same period. The win rate was slightly better at 67.5%, less than 1 percentage point improvement. Profit factor came in at 1.62, which is also modestly better than the standard RSIs at 1.54. So here's the question you might be asking yourself. If the win rate and the profit factor only improved modestly, how did the total return more than double? And the answer is trade frequency. The time-weighted RSI indicator generated 44,861 trades. That's more than 2.5 times the number of trades that the standard RSI produced. Now, because the exponential weighting makes the RSI calculation more sensitive to recent changes, it triggers the oversold condition more frequently. It's not finding better trades, it's finding more of them at roughly the same quality level. And with over 44,000 trades, that small per trade edge compounds into significantly more total return. Now, that additional sensitivity does come with a trade-off. The maximum drawdown with weighted RSI was 3.45%, compared with 2.23% for standard RSI. When you're taking more trades, you're exposed to the market more often, and that means deeper drawdowns during rough patches. There's more upside, but there's more risk per position. On a positive note, 430 out of the 613 stocks finished in profit territory when using the weighted RSI. Now that compares to 397 with the standard RSI. So the modification picked up an additional 33 profitable stocks that the standard calculation wasn't flagging, likely because the extra sensitivity found valid entry points that standard RSI just missed. Now, here's where things get really interesting. We ran the same exact test on a completely different 5-year period. This is the 2021 through 2025 period. And this period included some dramatically different market conditions. We had the post-COVID recovery, followed by the 2022 bear market, which was driven by aggressive Fed hikes. Then there was the 2023 recovery, and the AI-driven bull market through 2024 and 2025. So this is a fundamentally different environment from the first test. The time-weighted RSI tests returned 1.85%, which is virtually identical to the 2016 through 2020 results of 1.79%. Now, let's think about what that means. That means that the strategy survived a bear market, a rate hike cycle, a regime change in market leadership, and it came out the other side with essentially the same performance. Now, that kind of consistency across different market conditions is a sign that the underlying edge may be genuine and durable, not just an artifact of a particular market environment. Now, the standard RSI also improved from 0.71% in the prior period to 1.23% in the past 5 years. So both strategies performed better in the more recent period, which suggests that the post-2020 market may have created stronger mean reversion overall. But here's the nuance I think is the most important finding in the entire test. In the 2021 through 2025 period, the standard RSI took the lead in every quality metric. Profit factor increased to 1.57 for the standard RSI versus a decline for the weighted RSI from 1.62 down to 1.254. The profit margin was 22.61% versus 14.71%. And standard RSI actually had more profitable stocks with 437 out of 642 versus 429 for weighted RSI. So what we're seeing is a genuine trade-off. Weighted RSI wins on total return for both periods because it generates 2.6 times more trades, but standard RSI wins on per trade quality, especially in the harder, more volatile market. Weighted RSI makes more money just by trading more often, but standard RSI makes more per trade by being more selective about which signals to take. And that's not a one is better than the other conclusion, it's a which one matches how you trade conclusion. I think that's actually a more useful finding than simply declaring a winner. Both strategies showed a genuine edge across 10 years of data, across two very different market regimes. The question for you is whether or not you prioritize total return or per trade efficiency. Now, I performed a final analysis on the large cap stocks that looked at what would happen if we were fully invested in both strategies over the 10-year period. At any point in time, we could have up to 10 positions. Now, the standard RSI strategy produced an annualized return of 16.9% and a total return of 375.8%, while the weighted RSI strategy produced an annualized return of 20.2% and a total return of 529.1%. Now, due to the greater number of signals, the weighted strategy was fully invested more often than the standard RSI strategy, and the risk metrics reflect what we saw with the individual security averages. The weighted strategy was profitable in 9 out of the 10 years, with its only losing year being 2018, and the standard RSI strategy was profitable in 8 out of 10 years. Neither strategy had back-to-back losing years across the entire decade. Next, let's see how this played out on SPY specifically, because that's the instrument that most people associate with this strategy. Now, if we look at the 2016 through 2020 period, standard RSI generated 38 trades and returned 0.92%, whereas the weighted RSI generated 103 trades and returned 2.1%. This is the same pattern we saw on the full stock universe: more trades, more total return, and similar quality per trade. Now, in the 2021 through 2025 period, both strategies improved significantly on SPY. The standard RSI strategy returned 3.45% with a 75.6% win rate and a profit factor of 4.245. The weighted RSI strategy returned 5.93%, with a 76% win rate and a profit factor of 3.056. And here's the stat that I think is worth highlighting. Both strategies had 100% folds positive across all 10 years on SPY. Now, what does that mean? That means that every single annual window was profitable. 10 out of 10 years, including 2022. So on SPY specifically, the strategy just works. And it works consistently regardless of which RSI calculation you use. So here's where we stand. we've established that weighted RSI is a genuine improvement over standard RSI on the metric that most traders care about, which is total return. Both strategies showed a real, durable edge across two different 5-year periods that cover very different market conditions, and both were profitable every single year on SPY. But I didn't stop here. After these results came in, it just seemed to bring up more questions on, are there other ways how we could improve upon this weighted RSI strategy even further? What if we added volume-related filters to screen out low-quality entries? Or what about trend confirmation filters, such as using additional moving averages? And what would happen if we let the backtesting optimization engine optimize the parameters on a rolling basis instead of just using the fixed defaults of 10 and 0.5? So we tested it all. Volume profile filters, relative volume thresholds, positively stacked moving averages, and walk-forward parameter optimizations. 8 different strategy variations across 600 plus stocks. And the answer genuinely surprised me. The simplest version of the strategy, just a time-weighted RSI calculation using the fixed default settings without any filters or optimizations, turned out to be the best version. Every attempt to improve upon it either helped in one period and failed in another, or just made things outright worse. Now, in case I've not mentioned it before, I'm not a quant by training. My background is fundamental equity research. As such, I end up asking Claude to help analyze the data to ensure I'm not missing anything. And one conclusion that it came back with, which is probably one of the more interesting conclusions for me, was that it said that the strategy which cannot be improved upon through optimization is actually the strongest possible evidence that the edge is real, which is what we're seeing with both the standard and the time-weighted 2-period RSI strategies. Now, I ran tests using multiple factors, optimizing their parameters, and all of them underperformed the basic 2-period RSI strategies for the standard RSI and the time-weighted RSI. Now, I would guess that if we continued testing a dozen more variables and their related parameters, we'd eventually find a way to improve upon this model. Now, if you have any ideas, feel free to drop them in the comments below or in the Trading Blitz forums. But for now, I think we've kind of proven the point that the basic strategy is pretty damn good. Now, in the next video, we'll see how the strategies performed on ETFs, and then we'll isolate the best performing stocks and ETFs, and we'll create a top 100 list and see how that performs. So that does it for this video. Again, make sure that you're subscribed to the channel to get alerted for new videos, as well as to learn when we go live so you can compete for cash prizes in our free tournaments. Now, if you want to practice this strategy in a risk-free environment, head over to tradingblitz.com, where you can practice at your own pace in solo mode, or you can enter 2-player mode to practice under pressure in anticipation of the upcoming tournaments. Now, if you want access to the chart filters, trading signals, the trading teams, advanced statistics, and the Pine scripts that we build for this series, be sure to subscribe to our premium membership. Links are in the description. Also, if you're a finance content creator or you're thinking about becoming one, we've just launched the Trading Blitz affiliate program that was built specifically for creators looking to build their own communities. And here's how it works. When you become an affiliate, you can earn free premium membership when you create 3 videos using the simulator to explain trading concepts. Once you're a premium member, you can create your own group, a trading team, where you can collaborate with your members in your team's forums and live chat room. You can also schedule events and use the team's webhook to broadcast your algo trade signals that you and your team develop. By building your team on the Trading Blitz platform and adding value to the community, your payouts and commission window will increase. And members paying to join the community will have access to your team as well as the other trading teams and the premium features on the platform. So you're not just selling your team, you're selling the value of an entire platform which you help create. Affiliates who build their community on the platform will also have access to a private group for influencers, which is a space to learn from each other, to collaborate on videos together, and to grow our audiences together. My goal is for us to work together to build a successful community with high-quality learning opportunities for members. The link to sign up is in the description. Now, if you got value from this video, please hit the like button below, as it helps more traders find this content. And also, if you have any ideas for tests you'd like to see me conduct next, please drop a comment below. Until next time, Keep practicing under pressure to create diamonds and not disasters. I'll see you in the next video. Happy and safe trading. Thank you.